Hi everyone, welcome back to my channel. As you know, ESG is an acronym for Environment, Social and Governance. Environment is one of the ESG pillars. It's an extremely broad subject and one can speak years about it. Today I'll just scratch the surface to give it a flavor what's considered here. I will try to summarize what's included in the environment, what are the material aspects to the business, what can business do on these material aspects, and why is this important. Let's go. Both Oxford and Longman dictionaries give pretty similar definition for the environment as a natural world that people, plants and animals live in. In corporate world, environment is considered through double materiality assessment. On one hand, companies' use of natural resources and impact of its operation to environment directly or indirectly through its supply chain is considered. On another hand, the impact of environment to the business operations is being looked at. This would cover several topics: use of the resources, energy, land, water, emissions and pollution to air, land, water, waste management, biodiversity, climate change and resilience. Given the increasing severity of environmental risks to the businesses and the planet, the environment element of ESG becoming more and more relevant. How do we as a business understand what of the above mentioned topics are relevant to us and what do we do with them? For me, this includes several steps. First, define material aspects, draft relevant policies, set data metrics for collection and data collection itself, then data monitoring and risk identification and management, and reporting. Assessment of material aspects can be done both in-house and externally via engagement of ESG consultant, who would assess the value chain of your business and outline some gaps and risk areas to consider. In-house, you can do this through the accredited schemes, assessment portals, surveys and questionnaires that give a score in the end and highlighting the areas for further improvement. Few examples of such accredited schemes or assessment are S&P Global Assessment, CDP Questionnaire, GRESB, FTSE ESG Rating. You can also use GRI reporting standard as guidance. From all of the above, I prefer GRESB materiality assessment. First of all, it's available on their website for free, and material topics are defined by answering series of questions that are sector specific. The outcome is then automated and you have the rating for the risk areas marked as low, medium and high relevance. I wouldn't suggest to ignore low relevance aspects, but I would definitely focus on what's highlighted as medium and high relevance. For example, it can be air pollution in environmental section, health and safety policies in social, and fraud and anti-bribery in governance. I would then suggest that all aspects highlighted as medium and high relevance are addressed in companies' policies and risk assessment processes, that the reporting targets are set, reporting metrics are set. The data is then collected year on year for monitoring and reporting purposes. These data will also help you in your decision-making processes as well as in your medium and long-term ESG strategy. I would suggest that for the first 2 years, companies shall focus just on data collection and assessment of its quality. Once that data is available for at least 2 years, the company can then assess and start setting targets. For example, targets on reducing the energy irrespective of its source, whether it's renewable or non-renewable, reducing water consumption, increase the volume of waste that is prevented or recycled, some number and stats on how biodiversity habitat was enhanced. This can then give some substance for reporting. Another great way to define material aspects is to refer to GRI standard and its sector standards and sector disclosures. So far, only few sector standards are fully available, but for other sectors they have sector disclosures which can help you in defining material aspects. GRI did the pre-assessment of the material topics for the given sectors and they outline the processes that need to be addressed, hence giving you guidance on what to do and how to define these material topics, how to approach them and what needs monitoring. I like GRI because it's the oldest reporting framework since 2000. It's free, it's user-friendly, it's quite detailed, and companies can start using it irrespective of their size or budget. I always cross-check myself with GRI for guidance. Once the material aspects that potentially have a negative impact are defined, What shall we do with them? On a side note, I just wanted to highlight why we are focusing on a negative impact rather than positive. The thing is that we tend to do what's easier, and reporting positive stories is easier for us, and they sell better. Negative impact requires more thought and assessment, as this is quite a sensitive topic to any business. The potential negative impacts can be from the company to the environment and vice versa. So it's good to have a double materiality assessment to ensure that you protect and your business and the environment. Do remember that sustainability is not a philanthropy. So now you have understanding of your value and supply chain, you have defined your material aspects, now it's time to draft policies. The policy is a document that sets out the statement, which probably includes the description of this material aspect. Then it describes how this material aspect has a positive and negative impact to the business and to the environment. Then it comes to description of the process, as how you are going to measure that negative and positive impact. So you set some metrics to collect. Then you will address the means to mitigate those negative impacts. And then you set the objectives of what you want to achieve, short, medium, and long term as a business strategy. Policy is not a static document, and it can evolve and change and be updated, because with years you'll have more data, and these data will impact on your decision-making process. I would suggest to draft policies in simple language that any employee can understand and any representative of your supply chain, as you want the policy to work rather than be drafted as a piece of art and put to the shelf. This is why it's so important to include the description of the processes, assign the roles and responsibilities, explain the metrics that are going to be collected, mention the frequency with which it needs to be collected, and in which form and to whom it needs to be reported. It doesn't take a lot of resources or budget to do that. Most information is already available when you're pursuing business as normal. This is just a focus of what information needs to be extracted for the ESG reporting and targets. I would also say that alongside the policies, the risk assessment and the risk register exists, and that it's revised regularly. This will remind the stakeholders within the business on the opportunities and the risks that present themselves to the business. And while the wider team is engaged in drafting policies and participate in risk assessment, this can bring a good holistic overview of how the material topic impacts your business and operations. Do we need a lot of data? Yes and no, it depends on the sector and on the business and your defined material impacts. If you have a portfolio that represents different sectors and a big geographical footprint, then of course yes. But if you're a local or a national company or a small chain of coffee shops, then no. Companies pay utility bills, so it's very easy to extract the information about the energy consumption, water consumption, and perhaps the waste generation and utilization of waste. A company pays the bills to suppliers and contractors, so it's value chain. So it's easy to define where the money is flowing to and define what can be improved, like where the materials come from, what they are made of, and where they go to after the end of their life cycle. The businesses also have information about their revenues, so you can work out the intensities based on number of users in the coffee shop or the square meters built in the particular reporting period. So that can be useful to translate the ESG data into comparable intensities. If a company is building a new project, real estate or motorway, it's most certainly that the company is aware that it is potentially exposed to air or noise pollution or has a potential impact on land habitat. In this case, environmental impact assessment can be done prior to construction commencement. It can outline if some of the negative impact is unavoidable, for example, the number of trees that have to be cut to build a new motorway or a hospital. And then it can include mitigation and compensation measures for the construction phase and operational phase of the building to reduce the negative impact to the environment. For example, replanting more trees, building animal crossings, rehabilitating the shore, and so on. This assessment will also look within the business and will advise what the built footprint needs to be, so that the balanced proportion of the built environment and the green environment can be preserved for the benefit of the user. Reporting stage after the data collection is also important. It can be done internally in your in-house standard, or when you're already in line with GRI standard or any other standard that a company may select. But reporting is important because it's a communication tool within the business for the decision-making processes between different areas of the business, different functions of the business, as well as it's a communication with your stakeholders, with your shareholders, investors, community, authority, and so on. Transparency in the reported information conveyed is very important and is a very valuable tool to improve your business reputation. And as mentioned earlier, reporting of your sustainability work is a fantastic storytelling to your stakeholders and the whole world about your ups and downs, about your risks and opportunities, negative and positive impacts, and your aspirations to improve this world. Very often I hear this question, why me? Why my business? Why not many businesses doing it all and it's still okay? Why my business has to carry this ESG burden? It's a fair question, but personally I don't think that's the case. And more businesses are now aware of ESG and sustainability, about their impacts to the business and to the environment. And they are more and more voluntarily engaged in ESG and sustainability reporting nowadays. Also, more people are aware of it, and businesses have to address this issue to avoid losing customers. It's highly unlikely to see the business now that doesn't consider ESG in their business operations or do with a negative impact on purpose and don't prevent incidents happening. As I mentioned, sustainability is not philanthropy. Besides helping the planet, these practices can have a real financial impact to the business. For example, reducing the packaging materials that reduce cost, or reducing the weight of some materials that improve fuel efficiency during the transportation. All the measures that you can implement to reduce your energy consumption can also reduce your energy bills. And this is without even saying about the new customers that the business can attract to them with their philosophy and practices. This can also create an added value to your services or goods, and more customers are happy to pay for that. On the other hand, companies that neglect to consider their potential negative impact to the environment and don't address this in their policies or operations and practices can be exposed to a higher financial risk. Anyway, I just wanted to encourage you and say that integrating ESG is easier than it seems, and it can be done in stages to suit business capacity and needs and pace, so it can all be done. And I'm here to help you. I wish you all luck. Thanks. If you liked this video, please click like. Don't forget to subscribe to my channel. I will share all the important links in description to this video. Bye!